All right, welcome back to our Chapter 14 desk lecture. This is part 2 where we actually start getting into actually calculating and preparing the cash flow statement. So in part 1 of the video, hopefully you saw the different categories and are understanding how important it is. And this video specifically deals with the operating activities section of the cash flow statement. There are two methods of preparing the operating activities section of the cash flow statement. The first is called the direct method. And the direct method, and again, your textbook has got lots more information about this. I'm just going to kind of brush over it very quickly. The direct method basically states directly where the cash went, where the cash came from. It might say things like cash from customers, cash paid for inventory, that kind of thing. Again, it directly states in the operating activity section where the cash went. The indirect method, on the other hand, starts with net income and basically just does a bunch of reconciling steps to get to the number of the operating activities number. It's kind of a backwards way of doing it. I really don't like the indirect method. I think the indirect method is, not super informative and not really the best way in my opinion, but I can guarantee you that if I walked you through the direct method and walked you through the indirect method, you would agree with me that the direct method is way more difficult. So we're not even going to be covering the direct method. There's one other reason why we don't cover the direct method. The second reason is that if you as a company choose to prepare your cash flow statement using the direct method, you also have to prepare a reconciliation to the indirect method, meaning essentially you have to do both methods. And so you can probably imagine what you would do if you had to do both methods doing direct and you only had to do it once doing indirect method. You would just do the indirect method, and that's what all the other companies do as well. So every company essentially uses the indirect method now to the point the direct method is almost a dinosaur method and not used by anyone. It's very, very rarely used. It's still in your textbook, and again, if you're curious, you can take a look at the coverage in the textbook. If you are taking intermediate accounting eventually, you will see and be responsible for the direct method going forward, but it's just not going to be in this class. All right, so the direct method is basically, like I said, it's using net income and then starting to derive where the income comes from, what the cash components of net income are. So you can see here's our income statement and here's our balance sheet. And I put these here for a couple of reasons. First is just to add a little context so you can see where we're headed. The second reason is that it might be a good idea for you to get these and kind of maybe take a picture with your phone or do something so you can reference them as we progress through the video. I think it's important. In my class, I print these off and bring them to class so students have them so that when we're 5 or 6 slides later, you can actually look and take notes and do stuff like that on the printed versions of the income statements and the balance sheets that are here. All right, so let's get into it. So there's 4 steps to the indirect method of the operating activity section of the cash flow statement. The first is net income, meaning you just write net income on your cash flow statement and then move on to step 2. Pretty easy, right? The second step is to add back depreciation and any other non-cash expenses. Again, this is the cash flow statement. We're trying to show what happened to cash. And if there's things in net income that aren't cash related, they need to come out. Things like depreciation, amortization expense, bad debt expense, items like that come out. In addition, we're going to add losses and subtract gains. And then our fourth step is to adjust for changes in current assets and current liabilities. More explicitly, gains and losses are opposite. That's essentially what this says. We're going to add back losses, which is the opposite, and subtract gains, again, which we don't normally do. And we're going to do assets are opposite, which I will talk through what that means when we get to step 4. Now, one statement I want to make before we move forward. If you follow these steps, you will be able to successfully prepare the indirect method operating activities section of your cash flow statement. You don't need to know why the steps are what they are. You have no reason to know why we add the losses and subtract the gains or anything like that. That's just simply not necessary information for you. But if you are interested and if you are curious, at the end of the video, when we get to the worksheet spot where we normally stop the video, I'm going to basically wrap back to this and talk in a little more detail about especially steps 3 and 4 so that you might have a little context for why that's happening the way it is. Again, it's entirely up to you. I'm not going to come and knock on your door and ask, oh, did you watch the rest of the video? It's not going to happen. You do you. Get the information you need. And in my opinion, some classes where I get in, the students ask me and I kind of have to get into some of these details, I feel like they're worse off than they would have been if they just said step 1, boom, step 2, boom, step 3, boom, step 4, boom, and then moved on with their lives. So just keep that in mind as we go forward. All right, so step one, net income. You can see on our income statement here, our net income is $42,500. That's step one, right there at the top. Net income, $42,500. Step two is depreciation expense. And depreciation expense in this example, I actually am combining them together just to keep my cash flow statement somewhat more abbreviated and concise. I could have put these separately in my cash flow statement as well, just a small note. But there's step two, depreciation expense, $7,000. Step three is losses and gains. And so starting at the top and going down, I have a gain of $4,000. And so I'm going to do the opposite and subtract it. Loss on sale of vehicle, you can see it here, $2,000. I'm going to do the opposite and add it back. Essentially removing it from this calculation, removing it from income. Now we start to the changes in current assets and current liabilities. One note before we start, you do not incorporate cash in with this step. You skip cash for this step. Completely skip cash for this step. We'll talk about this change at the end of video 4, but for right now, just ignore this top cash line and start with accounts receivable. So as you can see, accounts receivable decreased by $12,000. One other note, as you're doing these increases and decreases on the balance sheet, make sure you're keeping track of where the beginning and endings are. Sometimes they're left to right, sometimes they're right to left. Just make sure you're stopping and keeping track. Here, accounts receivable started at 32 and ended at 20. That is a decrease of $12,000. Now, the rule is assets are opposite, which means this asset went down, and so we're going to do the opposite, and we're going to increase. So the change in accounts receivable in our case means an increase of $12,000. Moving on to inventory. Inventory went up 7, and because assets are opposite, we're going to decrease it. Moving on. We're skipping equipment and vehicles because those are investing activities. Kicking down here to accounts payable. Accounts payable went down $8,500, but accounts payable is not an asset. So we do not do the opposite for accounts payable. We keep it as a minus. Salaries payable went up $2,000. Again, salaries payable is not an asset. And so we're going to add it just like it says. Boom. There is our operating activities section of our cash flow statement using the indirect method. Again, this 4 steps, once you know how to do the 4 steps and do it a couple times, it's really pretty easy to manage, in my opinion and in my experience with students. So here we have net cash provided by operating activities, $46,000. And this launches us into worksheet 2, which is a balance sheet and income statement. And then I ask you to prepare the operating activity section using the indirect method. Keep in mind, worksheet 3 is the same page, only I ask you to finish the cash flow statement based on stuff that'll be in the videos 3 and 4. So my suggestion to you is print worksheet 2. You don't even need to print worksheet 3. Print worksheet 2 and just plan on working off of that. You can obviously print all the worksheets you want, but that's my suggestion to you. Good luck, and I'm going to stop for like a second or two and then have a drink of water, and then I'm going to start back on my explanation for why we do the opposite for gains and losses and assets and things like that. So good luck if you are heading to worksheet 2. See you at video 3, and if you're sticking around, let's get to it. All right. So let's talk about this. So this is the step, and again, I've had experience with students where most students just say, whatever, I don't care why this rule is the way it is, I'm just going to use the rule and move on. But some students just want to know why this rule is there, why we're kind of doing all these steps. So the first rule I talked about, I'm just going to repeat, is actually step 2, which is add back depreciation. Remember, this is the cash flow statement. We're looking for what happened to cash. And we're starting at net income. Net income's a decent place to start because net income includes all the operating activities things we want. We want the day-to-day business activities. And net income includes all those day-to-day business activities. But it also includes some stuff that we don't need. Depreciation expense is the most common, and you'll see it in every cash flow problem you do, and you always just add it back. It's a non-cash expense, and so it gets subtracted to get to net income. And so if we want to basically erase it or rub it out, we have to add it back. The same thing is what we're doing in step 3. By adding losses and subtracting gains, we're just removing them from income. We added the gain to get to net income. And so by subtracting it, we're basically taking it out, and we're doing the opposite for losses. Those losses and gains for fixed assets, which is what they are in this case, are investing activities. You will see them in video 3. They don't need to be in the operating activities section. They're only in there so that we can remove them out of net income. All right, so adjusted all changes in current assets and current liabilities. For the assets especially, if you look at the different types of items that are in the operating activities section, for instance, take revenues and cash from customers. All right, so if we go from revenues to cash to customers, obviously net income includes those revenues. But in order for us to get to the actual cash amount, we have to consider accounts receivable, right? So let's say we have $100,000 in revenues and accounts receivable went up $10,000. But what that means is that some of our revenues we didn't actually get paid for because they're sitting in our accounts receivable account now, right? And so if accounts receivable goes up, that actually means we got less cash. And that same thing works between cost of goods sold and inventory. If cost of goods sold is, say, $50,000 and our inventory went up, that means we actually have more expense in there than we need, and so we need to make the opposite of that difference. So any asset-related items have a negative or opposite cash effect. And so if an asset goes up, that by definition means we spent less cash than we would have had that asset not gone up. And so we need to do the opposite as we adjust cash out for those. Your textbook will have an extensive conversation about the direct method. And if you look at all those items, all the asset items that appear on there, you always just do the opposite for each one. And so again, you can kind of get into the rule if you want and have a little bit more, details into that if you want. But really it's just a matter of the cash effects of asset changes are always opposite. If an asset goes up, that means that cash account wasn't impacted. So instead of getting cash for those revenues, accounts receivable went up instead. Or instead of having that expense hit, the inventory went up. And so those all have an opposite cash effects. Good luck. Thanks for sticking around. If you have more questions on this or want to get into more details about why this happened, please reach out to your instructor. Their explanation might be better than mine. Your textbook also has a reference for it as well. So good luck on your operating activities section of your cash flow statement. I'll see you in the next video where we get into investing activities.